Hi, and welcome to our presentation on More Than a Numbers Game, Chapter 10, Intangibles. I'm Kelsie Sullivan, and joining me is Nikki Holmes and Yuqing Wang. Let's talk about learning objectives, specifically what you can expect to take away from this video. As mentioned, the topic will be intangibles, with an emphasis on what's covered in MTANG Chapter 10. We also included relevant information from other sources that we thought would be of interest to you. Those references can be found on the last slide of this presentation. In addition, links are included throughout the slides to make it easy for you to locate the resources specific to that portion of the presentation. A copy of these slides are linked below. First takeaway, you will understand on a conceptual level what constitutes an intangible asset, and be able to identify whether an asset is tangible or intangible. This includes being able to name specific types and categories of intangibles and describe them, including key characteristics and how they are similar to or different from other intangibles. Next, you will know the business importance of intangibles and how they have played a role in shaping some industries, company market valuations, and accounting standards. And speaking of accounting standards, you're going to learn a lot about policy related to intangibles, how it has changed in recent years, and the organizational bodies that are driving that change. And of course, how those policies can be applied to appropriately account for intangibles on financial statements. By the end of this presentation, you will be able to think critically about and identify the strengths and weaknesses related to intangibles. To aid in this, case studies of real businesses and practices will be highlighted throughout. Now for something a little more fun. As an incentive to stick it out to the very end, we are offering a prize to one lucky and intelligent classmate. How it works. There will be pop quiz questions scattered throughout the video. Answer each question correctly in the comment section below, and you will be entered into a drawing for an Amazon gift card with credit enough for a new release Amazon Video movie rental. The winner will be announced and the gift card emailed Friday, April 3rd. With that, I'm going to pass this presentation off to Nikki to get us started with the definition of an intangible asset. Take us away, Nikki.
Thank you, Kelsie. So let's start with the definition of intangible assets. Intangible assets are valuable resources that are not physical in nature. It's useful to compare and contrast tangible versus intangible assets. Tangible assets are visible, they're easier to value, they can be replaced more easily, such as land, inventory, and receivables. They're easier to replicate, and creditors prefer them as collateral. One commentator noted, "If you can't kick it, how can you borrow against it?" Intangible assets, on the other hand, are invisible, they're difficult to value, difficult to replace, and they cannot usually be bought or sold without the sale of a firm that owns them. They're much more likely to lead to a competitive advantage, as we will discuss further. Examples of intangible assets include intellectual property, such as patents, trademarks, and copyrights, and company culture, brand recognition, process knowledge, supplier relationships, customer loyalty, and goodwill. As we can see, these things are very difficult to value, but they take a lot of time to develop, and they are extremely valuable. They are difficult to replicate, and for these reasons, they are much more likely to lead to a competitive advantage than tangible assets.
Which brings us to our first pop quiz question. You are employed by a fast-growing, publicly owned startup named Your Face that produces medical masks. Your R&D team, Go Team, is getting close to completing development of a new manufacturing process that increases bacterial filtration effectiveness from 95 to 99% without increasing cost. This new process, along with all the specialized equipment required, can be considered an intangible asset for the company. True or false? Don't forget to answer the question in the comments below. To reduce confusion on our part, please answer all questions in one comment. No guarantee we won't miss one of your answers if you choose to respond to each question in a separate comment. Sorry about that. Back to you, Nikki.
All right, so next let's look at the Dow Jones Industrial Average price to book ratio over time. From 1933 to 2002, we can see that the importance of intangibles is reflected in this increasing price to book ratio over time. The price to book ratio of 1:1 indicates that investors value a company's net assets exactly as they are shown on the balance sheet. So the share price would be equal to the book value. Before the 1980s, the ratio was consistently between 1:1 and 2:1. This ratio rose dramatically after the mid-1980s, indicating that investors assigned a significantly greater value to those stocks than what was represented in the balance sheet as net assets. It reached a peak of 6:1 at the peak of the dot-com bubble in 1999. More recently, the Dow Jones Industrial Average is around 3:1, according to Bloomberg. Let's take another look at a graph here. This is the declining importance of book value in a firm's stock market valuation from 1980 to 2015. As we can see, the intangible portion of the market value increased from 20% in 1980 to 75% in 2015 among S&P 500 companies. This helps explain why Tesla, valued at $94.8 billion, is more valuable than GM, valued at $30.5 billion, as of Friday, March 27th. While GM delivered over 2 million vehicles last year, Tesla's global deliveries totaled 367,500 vehicles, much, much less than GM. So many of the most valuable companies in the world have large amounts of intangible assets. Just look at the tech sector. Many of them benefit from intangibles such as network effects, vast amounts of customer data, and intellectual property. Moving on to the next slide, intangible assets and competitive advantage. So as we mentioned, successful companies are using culture, process knowledge, relationships, and brand equity to get ahead. This allows them to better compete with differentiation or cost leader strategies. Competitive advantage is leading to increased and more assured cash flows over time. So to better exemplify this, let's look at a case study of Microsoft on June 30th, 2002. So during a third consecutive year of a bear market, their book value was $50 million. Their market value was $300 billion. This was the highest market capitalization in the world at the time. The price to book ratio was 6:1, and the intangible assets noted on their balance sheet totaled $1.7 billion. This was less than 1% of their total market capitalization. The gap between the book value and the market value must be explained by intangible assets. Investors recognize that the value of their software, culture of innovation, established corporate relationships, brand equity, and growth potential. The software that they used was used in 90% of PCs globally. Kelsie, moving on to you.
All right. Time for another pop quiz question. The CEO of YourFace approaches you, the CFO, about abandoning the new manufacturing process because of the high upfront costs. Instead, she thinks YourFace should produce masks with fun designs and colors that will appeal to customers. What is the response below, or best response? Review the responses below and choose the best response. Without further ado, back to you, Nikki.
So the problem with intangible assets is a lack of reliability. There's really no way to reliably value the internally developed intangible assets without a market transaction. But as we've noted, they're absolutely relevant to the company's valuation. So in 1944, the Committee on Accounting Practice addressed this issue with Bulletin 24 on intangible assets. They said that intangibles were differentiated according to purchased versus developed internally, and those with finite lives, like licenses and patents, versus infinite lives, such as goodwill. No instruction was given in regard to valuing the internally created assets. Purchased intangible assets were to be valued at cost with amortization scheduled over the period in which the benefit was received and impairments written off when appropriate. The big bath intangible assets were allowed to be captured on the shareholders' equity, avoiding the income statement altogether. This resulted in less visibility and notably different from the concept of posting large write-offs in one period to manipulate earnings for the next period. In 1970, the Accounting Principles Board came out with Opinion 17 on intangible assets. They created a 4x4 matrix and differentiated internally developed assets versus purchased assets and identifiable assets such as patents, franchises, and trademarks versus unidentifiable goodwill like culture, brand equity, and supplier relationships. This created 4 types of intangible assets: internally developed identifiable assets, purchased identifiable assets, and internally developed and unidentifiable goodwill, and purchased unidentifiable goodwill. Goodwill is defined as the difference between the amount paid to acquire a firm and the fair market value of the acquired firm. It's made up of things such as brand equity, firm culture, and corporate relationships. Again, things that can lead to a competitive advantage. Researchers have found that purchased goodwill can be statistically significant in explaining share prices. In addition, Opinion 17 stated that intangible assets have finite lives. Thus, they need to be amortized over the period that they provide benefit, which is no greater than 40 years. This 40-year rule was used to decrease the variety in accounting practice, but many disagreed with the rule, reasoning that it was not universally applicable. Amortization schedules should be chosen according to expert judgment rather than an arbitrary number, some argued.
All right, it's time to play Who Has Been Paying Attention and Who Has Been Multitasking on Their Phone? Question 3. The CEO of Your Face decides that moving forward with the new manufacturing process is the right thing to do. She asks you, the CFO, on how this new process will affect the company's financial statements in the current year. Please review the answers below and choose the most accurate response. I look forward to reading what you guys think. Don't forget the answers, along with the name of the drawing winner will be announced Friday, April 3rd in the comment section. Now to Nikki, who's going to kick off the discussion related to research and development costs, also known as R&D.
Thank you, Kelsie. So in 1974, FASB came up with Statement 2, Accounting for Research and Development Costs. They had noted that 2% of the US GDP was used for R&D. So they decided that R&D costs should be expensed as they were incurred. The goal was to decrease variety in accounting practices. And the rationale was that rationale was the unpredictability of the amount and timing of future benefits arising from R&D efforts. In addition, there is no causal link between the R&D costs and the revenues that they generate. Eugene Flem, a controller at GM, called it the worst standard ever established because managers could no longer exercise their judgment. However, managers still needed to use their judgment to differentiate R&D work from other company work. So FASB helped define R&D further and said that research is investigation with the goal of finding new knowledge, and development was the transformation of new knowledge into a process or product. And Yuqing, I'm turning it over to you.
Thank you, Nikki. So in 1985, FASB issued Statement 86, accounting for the cost of computer software to be sold, leased, or otherwise marketed. For accounting policies for computer software, it requires expense R&D costs up until technological feasibility has been established. According to FAS 86, technological feasibility is established upon completion of a detailed program design or, in its absence, completion of a working model. Software production costs should be capitalized on balance sheet and amortized over the project's estimated economic life, and the accounting policy requires to record capitalized costs at the lower of amortized costs or net realized value. So in the next slide, we're gonna talk about the IBM acquired Lotus in 1995, and the independent appraisal firm hired by IBM expressed an opinion on the fair market value of the assets of each of the acquisition to serve as a basis for allocation for the purchase price to various classes of assets. 10% of the purchase price were determined for tangible assets acquired like cash, receivables, and buildings, and 60% of the purchase price represent the purchased in progress research and development. Some explain that the management practiced spring loading by taking a huge one-time charge to deprice the base of reported earnings and avoid having to amortize capitalized expenses in future accounting periods. To get companies an allocation of purchase price to tangible and intangible assets obtained through purchase, merger, or acquisition, FASB released Statement 142. Statement 142.
Yuqing, before we get into the meat of Statement 142, it's time for pop question number 4. The CEO of YourFace reads that once technological feasibility is established, production costs can be capitalized on the balance sheet and then amortized over the economic life of the project. It comes to you, the CFO, to see how to make this happen. Please review the responses below and determine which is the most appropriate. Okay, we're headed into the home stretch, so Yuqing is going to tell us more about pooling and dirty pooling, including FASB Statement 142.
Thank you, Kelsie. So let's back to Statement 142. This statement changed the unit of account for goodwill and takes a very different approach than OPN 17. Statement 142 concludes that goodwill and other intangible assets have indefinite lives and should not be amortized arbitrarily. This statement provides that intangibles should be tested for impairment at least annually, and any identified impairment should be charged to income. The statement also created the perspective of volatile earnings from unanticipated impairment. Next, we're gonna talk about the case study for American Online. In the mid-1990s, American Online reported costs for sending disks to potential customers as an asset on its balance sheet instead of expenses the costs as incurred. The SEC filed a complaint against AOL for civil penalties, and in settlement, AOL agreed to pay $3.5 million to settle financial reporting valuation. In January 2001, it had been announced the merger between AOL and Time Warner, aimed to create the world's first fully integrated media and communication company for the internet century. When the all-stock merger was announced, the company valued it at $147 billion. As shown in the slide, the company's goodwill portion is over 60% of the total assets. Under Statement 142, companies have discontinued amortization of such goodwill. Thus, cost AOL Time Warner arrived at a $54 billion charge. Next, we're gonna dive into pooling of interest. Pooling of interest refers to a technique of recording a merger or acquisition whereby the assets and liabilities of the two companies are summed together and then netted. As of pooling, the predecessors firm didn't sell their stock, but returned an interest in the new company, and the successor firm didn't purchase shares from either party. Lower asset values limited the firm's ability to secure rate increases. There is a recommended rating below for whom interested in the development of pooling of interest accounting for business combinations. Next, we're gonna discuss about the differences between pooling and the purchase treatment. Before being phased out by FASB in 2001, pooling of interest was the most preferred technique because it usually results in high earnings for the surviving firm. It adds balance sheets and income statement from the beginning of the year, and it generates higher reported revenues and earnings, spread the new entity's income statement depreciation charges. So a vast majority of technology firms use this technique, so they didn't need to record any expenses arising from the acquisition. This approach also made earnings look better since no reduction of goodwill were recorded. But in an article written by Abraham Breiloff, he demonstrated that accounting statements were like bikinis. What they show is interesting, but what they conceal is significant. He described pooling treatment as dirty pooling, as it might be misleading to stockholders. On the other hand, the purchase method gave a truer representation of the exchange in value because assets and liabilities were assessed at fair market value. So to curtail pooling abuse, in 1970, ABP imposed 12 conditions to be satisfied before pooling accounting could be used. And in 1999, FASB announced it would eliminate pooling of interest accounting for business combination. And in the following year, it announced that goodwill arising from purchase accounting need no longer be amortized. FASB issued statement number 141 in 2001, ending the usage of pooling of interest method. Then there's only one purchase method for accounting for business combinations. A revision to statement number 141 issued in 2007 that the purchase method was to be outdated by another improved methodology, the acquisition method. Next, we're gonna talk about the treatment of intangibles in nowadays. All intangible assets are recorded at cost and be broken into two categories with limited useful lives, such as patent, and intangibles with indefinite useful lives, such as renewable broadcasting license. Intangibles with limited useful lives, the cost is amortized over a number of accounting periods. Amortization is credited to the assets account. And for the indefinite intangibles are subject to periodic impairment tests. Impaired intangible assets carrying value is written down to its realizable value. A charge equal to the written down is made to the income. And for goodwill, cost is difference between the price paid for a company and the fair value of the net asset acquired. Goodwill will be tested for impairment at least annually using a two-step process. Step 1 is a screening test for potential impairment, and if impairment exists, step 2 is measure the amount of impairment. As of R&D, costs are expensed as incurred, and the costs of developing marketable processable products are capitalized once the product's technological feasibility is established. Now, Kelsie is going to give you another pop quiz.
Thank you so much, Yuqing. So, fifth and final question, the end is in sight. Another manufacturer of medical masks is interested in acquiring your face. They have established infrastructure that would be perfect to realize your FACE's new manufacturing process and could quickly bring the advanced product to market. Your FACE's CEO comes to you, the CFO, to ask your opinion. Review the 2 choices below and choose the most appropriate. And this is also a daily nubble. Defend your answer to question 5 in 1 sentence and receive an extra entry into the drawing. All right, so that means we get to wrap up this presentation with a quick summary of what was discussed in this video. You can kick a tangible asset, but you would look like a crazy person if you tried to kick an intangible asset. Intangible assets can be broken down into 2 broad categories: finite, which is patents, trademarks, and copyrights, and indefinite, which are things captured in goodwill, such as brand culture. Intangible assets can be vital to the success of an organization, giving a valuable edge over competitors. Internally created intangible assets are not reported on financial statements, other than possibly being disclosed in the notes. Externally acquired intangible assets are reported on the balance sheet based on the market transaction price. Finite intangible assets are depreciated over their working life, although those may have the possibility of being renewed or extended, while indefinite intangible assets are tested annually for impairment. For those who are interested, a copy of the slides and a handout highlighting key takeaways from this presentation are linked below. Don't forget to answer the pop-up quiz questions in the comment section below for a chance to win an Amazon gift card. Thank you for your time and attention. Stay safe, stay healthy, and stay sane.